Give me
Yeah,
a second.
you do your.
So Alexa here asked me how to start with a completely new chart, the things that I look for, and he also asked to record, which is, overall a nice idea for anyone who never did a completely new chart. So I'm going to try and not forget steps that I do. But basically, in a more overall way, this is how I would start if it's a new coin or if it's a new asset in general. Whether it's, I think most of the things, Alexa, that we're gonna talk about, most of the things can be seen in TradingView. There are some exceptions, which is liquidation levels, because we have high block for that, and things like stacked imbalances and stuff because of exo charts. But other than that, uh, what I'm gonna try to explain to you, I think they're kind of universal. Okay,
Okay, okay.
so the first thing that I do, whatever the coin is mark out monthly, weekly, and daily levels. I also do this if we start a new month or if we start a new week. Um, when we start a new month, I mark out or update any weekly level that has changed. And when we start a new week, I mark out daily levels as well. The way that I do them, it's actually quite simple, and it's basically looking for candles like this that have the open and close at the same level, but that weren't tested on the next one, and they are left alone for some time. So what I do is I come here and I put a line there. I have a template just for this, and then for example, I would also do this one because again, the open and close are synced, right? They're as they should be, but they are not tested after that. Okay, so we have this one, and this one on the monthly chart. Okay, we also have this one, but I think it's kind of irrelevant, considering, I don't know, if we drop to 30k, the world is gonna die and stuff. Um, so after doing this, folder, because if you don't create folders, everything will be super messy when you look at the object tree and you want to hide stuff, because it's going to be important to hide stuff as you go. So after doing this, I'll keep them on for now. After doing this, I change to the weekly, and essentially we do the same thing again. So on the weekly, we have this guy over here, which as you can see was already a nice support and resistance here. We have this guy over here, this guy, we have this one too, and I'm not sure if I should put this one or that one. They both seem relevant because of what happened here and also here, but the upper one was also relevant because of what happened here. Why not just keep both? We'll also have this one and the all-time high, one of the all-time highs, and this one, and this one. Not as important. Well, kind of. And this one over here, this one's really nice because of this. And I think that's it. Currently, we have kind of a new one, I'm saying kind of a new one. You'll understand what I mean by that, because this was immediately tested, right? So maybe not a good example. But basically, yeah, I would have these guys. Now, in terms of filtering, you should, however, try to filter them into the ones that are more relevant. And the way you see the ones that are more relevant is just by basically marking out the ones that didn't have much of a reaction, or that proved themselves to not actually be that much of a resistance or and support. For example, I think this guy is kind of irrelevant because it was like in the middle of most bodies, and this in turn seems like a much better range. Um, this one, for example, is a little bit irrelevant if you have that one. And for example, this one over here is a little bit irrelevant because you have this one already that has a lot of wicks. Okay, so this basically leaves you right now at the moment, basically leaves you with this situation here, where it's extremely bullish if we stay above this guy, not so bullish if we stay below this guy, right?
Mm.
Then changing into the daily level, you basically do the same thing, but on a much more uh, well, I was going to say micro, but this is not exactly micro, right?
Mm.
uh, but it's the same logic. I'm on the daily, so now you do the same logic, and we have this one.
Mm.
Oh, wait. Okay, these are all weeklies. Okay, you have that one, you have this one, you have this one, and that one, and oh, this one too, and this one, and that one, and I think that's it. For example, this is one of those subjective cases where if I put the line here, it makes a total amount of sense, even though it was tested. So this comes a little with a little bit of subjectivity. You have to look. The idea anyway is that you look at places where price was tested and retested a lot of times, so that you have a notion of where price can encounter difficulties, either going up or down that level. Okay.
Mm.
So this is like the basis just because of levels. What we can assume just from looking at this is that we are at a very strong resistance, right? This is an overall area where in the entirety of this range, this level was hard to breach, which is why I was telling you that technically in this zone you have kind of the technical obligation of looking for shorts, not exactly looking for longs. You should have been looking for longs when we were down here, or when we were retesting this daily level, for example. But right now, looking for longs is a little bit like, well, are you going to expect the 85 level? You can, but you know what I'm saying in terms of a range.
Yeah.
Longing right now, wishing for a swing trade, is less probable than shorting and wishing for a swing trade. A swing trade is more likely. So after doing this, I do a little bit based on this. I look at places that have become support and resistance over time. How do you see that? A little bit with the same idea of the wicks. You draw, for example, boxes from those places, and you draw them until the wick, and then you try to expand it, and you keep updating it. For example, when we were here, imagine that you're looking at the charts like this. When we were here, this is the obvious, like daily level, monthly level, this is the obvious support and resistance zone. That's all it is. That's all it's ever going to be. It's just a zone. It's not something that you should take into account like an extremely precise level that you can even use for a stop loss, okay? It's just a zone to look for trades in the opposite direction. But that's it. Don't expect more than that. As price evolves, and you see that it either breaks or closes below or things like that, you have the obligation to keep updating this box. And what I mean by updating it is you go to where you did have wicks and you update the box to the candle closes, which in this case we have to update it like this. And this in turn, for example, just by doing these wicks right here, it's interesting that you see a daily candle closing here, then it went down, and only then found power to go up against this level. When it took liquidity from these highs, it went back into this area and started to find support at the exact same area, right?
Yeah.
So this becomes like your daily support and resistance zone, and currently you can potentially update it like this, okay? So this logic, you would do it the other way around. So for example, where we have another situation like this was when we got up to the all-time high, but as price moved on, you can, for example, update it to something like this, which, if you notice, it's not a coincidence that it's where we're struggling to get above. We're struggling to get above because this is general area where price got, well, not got, found trouble in getting past. And that together with the daily levels and everything, for example, this gives you a nice TP as a target if you were long. Like I'm talking about how can you use this, right? This is not exactly for a stop loss, but for example, as a take profit target is a good practice. And so, where is it? SR zone, okay. For example, another place that we have similar to that is it's these highs that were support and resistance here, or still support resistance here, or still support resistance here. So you could, for example, update it to something like this so that it matches the candle closes. But at the same time, for you to include the last wicks, you would have to do it like that. So it's kind of useless to update that one. Because again, this is not to be millimetrical, it's just an area.
Yeah.
Okay. So that's support and resistance zones. I wouldn't create more right now. And that's another folder. So these four, these are the first ones that I do. One thing that I like to do as a test is after you have this box, or actually let's do this one because it was the first one that I did. After you do this box, I come here to the settings and I choose extend left. What it does and what it allows you to see if in the past it was actually an interesting support and resistance area. And for example, in this case, not so much, even though you have some daily candles that struggle to get against. And for example, it's super interesting that these guys, this one especially, touched it exactly. And keep in mind that we did this looking at the current price action, not price action from 2021. But still, you have like a sniper touch there. Then in 2021, but closer to the end of the year when we did the previous all-time high. Clearly, this appears to be a nice area as a support and resistance zone. Judging from this, we can do an experiment, which is drawing a box like so, updating it to this zone, just the wicks. And now let's do the opposite. And it's this box that I did. It's not as good, but for example, when we got here, we struggled against it. Then we struggled against this area, used it as support here. This was choppy action, basically. But still, it's an interesting box to keep, okay?
Yeah.
So, support and resistance zones, check. Just based on this, you can see places that are likely to be a good reversal area. This right now is a good reversal area. This right now is a good reversal area. Blasting through that, this is a good reversal area. Like where you see more lines stacked with the support and resistance zones, that just basically tells you, like from a swing perspective, any trade, if for example, if this bull run fails, if this is not the restart of the bull run, easy target would be this. Second easy target would be either this one or that one. Maybe here because it has a lot of levels, right, stacked together. And in this case, we're on a daily, so stacked together can actually mean like the separation of $2,000, like this. But you know, when and if you swing trade, um, you're not exactly going to be worried about the move of $50 or something like that, right?
Yeah.
So this is for the monthly and dailies. Now, when this happens, and so for example, we have just established that we are on a resistance zone, okay? Things to keep in mind, and this is now talking about liquidity. For example, we had previously these highs over here. We took them, and we had this guy over here. We just took it. The question now is what will happen if and when we get up to this high, because there's not any certainty that we're going for that high, right? We're at a resistance level, so maybe price can reverse already, or maybe price can do like one last desperate touch and take that liquidity but then fall. At the same time, from this high to that high, these are like stacked highs, especially if you compare it to this guy. So right now, just from this, now you have a trend line. And for example,
Perfect touch.
the simple touch of the trend line can mean that we're now going to reverse and going back to a support zone. None of this is ever certain, and trend lines are drawn in very different ways. Like, for example, Andre, I know he likes to try and include as much touches as possible, so we would have to include that. So in that sense, we are already a little bit above that. Some people just do it from wicks to wicks. Other people do it from bodies, not really including the wicks, or thinking about the wicks. So for example, us closing a daily before this trend line is possibly a very bearish scenario. But what I mean is, all of this, all it does is just confluence, okay? So
Yeah.
theoretically, we're at a resistance level. For example, one thing that you should look for is where are gaps when you're looking at this at a daily chart. And for example, right now, there's only one gap that has not been tested on the daily time frame, which is that one. because every other gap has been tested. I mean, there's actually only this one and that one. So this one was completely filled, and apparently it used this as a support to get up there. So in theory, if it comes back down, and for example, if we create a daily fair value gap, the possibility of coming for this is super, super high. All we need is something like, for example, an engulfing daily candle, closing completely below this, possibly then creating another gap, and or possibly creating a range up here and then breaking out of it, meaning that even if it has a day where it pushes back, it will probably just react to that range and then continue down, so on and so forth. But having these main gaps, the more important ones, is especially important. On the weekly, for example, we also have a weekly gap, even though it's small. But it's small on the weekly. It's kind of subjective. In this case, it means like $500, 500-ish. But yeah, it's relevant enough, you know. So if we start coming down, the logic would tell us that we would probably go for that fair value gap on the daily. So what's important right now is having this marked out as possible liquidity. Sorry, wrong template. And for example, it would be important in terms of execution to just leave an alert there. Okay. Just going to change this to price alert, just so that I know that it's just an alert. Another thing that you want to check is just like this, where are other types of liquidity but stacked together. And for example, these lows are actually not that bad, but these lows over here are terrible. We have 1, 2, 3, 4, 5, 6 days of ascending lows. These types of situations very rarely can hold price. So I would mark that as well, thinking that if we come down, break this fair value gap, and imagine that I'm in a short from up there. If we break this fair value gap, I know that we're going for those lows. I don't have a crystal ball, but the probability is so high that it really wouldn't make sense to not think that it wouldn't go for that, you know. In this case, this range over here, the lows are not so bad because, for example, this low is actually a pivot. Took the low of that previous day and only then changed direction. So we started here, but we went back for the low and only then pumped, okay? So that's a good low. And from that same perspective, we also had, for example, these even look like equal lows, sorry. We took that little range, right? That liquidity of that little range and then pumped. So this is not a bad low. So for example, what will technically happen if we SFP this high is that in theory we are making this lower section weaker, because it would mean that it's a failed breakout attempt. And when we fail to break out of certain areas, the opposing liquidity becomes a target. So this would be the opposing liquidity. The logic that you can assume is if this becomes a target, and if it is taken, where is price possibly going to find support after taking this? And that is where we come back to these levels. So for example, this is already a support and resistance zone, And I was just saying that these lows are not bad. If they break, we have this area which is a daily fair value gap, which gives you an immediate idea and conclusion that if we get into a short, logical place to take profit is maybe at this daily level, because it will be probably the point of control of these days in terms of volume. But if it fails, like, take some profit out here, because if this fails, uh, and these lows will then become targets, are we supposed to expect that this will hold price? Not exactly, right?
Yeah.
So if this fails, we will come for the daily gap. If the daily gap fails, we have a very easy liquidity grab to catch. So you can see the kind of a cascading effect that we can have here, right?
Yeah. So after the support, the zone, the levels, you find liquidity that like those
Yeah. The idea
ugly
is,
lows and highs.
exactly. The idea is, first you mark out the levels just so that you can understand, are we at a resistance or are we at a support zone?
Yeah.
After that, you look for liquidity, and basically you sit on your hands until you see that price took some liquidity, and then you go into the chart and take a look at what is exactly happening. If the reaction is looking like more of a failed attempt, or if it actually closed above or below that level, depending if it's a high or a low. Because, for example, let's imagine this scenario. Let us imagine that now we actually close a candle above this level. We we are going to have a bias, which is a correct technical bias, that even if we drop after doing that, uh, there's it is more likely to have success on a continuation trade that pushes us even further than to actually expect a short to down here. You can get a short anyway, but you have to be aware that we closed above that level, so the short might only have the potential to being a scalp, for example, not exactly a big swing trade down there, targeting down there. Okay, so
Mm-hmm.
it really depends on what type of price action presents itself after we take liquidity. So it becomes like macro levels, support and resistance zones, and then marking out liquidity zones to understand what might happen. Um, in terms of what you do from here, it is a little bit more subjective. What do I mean by that? It's more subjective in the sense, like, are you a swing trader, a day trader, a scalper, etc.? Because if you are a day trader, you can, a swing trader, you can now just go for the 4 hour, for example. And for example, in this case, we have these 4 hour highs that were taken, but price actually closed above them. However, we have also this 4 hour pivot, which can tell you that if we break below this pivot, and again, if the reaction is not bullish, um, then we can expect it to at least come for this fair value gap. So the logic of what I'm saying in the daily level and all those levels basically comes down to getting a bias here. In this situation, if you are a swing trader, it doesn't really matter what time of the day you are in, um, because for you to decide a trade, um, obviously there's always certain times of the day that can have more potential than the others. Like, for example, the New York Open will always be um, a higher volatility time than any other session. But in terms of deciding a trade, your logic should always be the same, which is you only decide a trade after the liquidity has been taken anyway. Because here's the thing, like, whether it's macro or micro, midterm, long term, doesn't matter. Price will always go from liquidity to liquidity eventually. Uh, doesn't really matter if there's an order block or a gap or if it reacts to this and that. Everything that happens in between liquidities, technically it's kind of like just noise. What you do have to find out about is after the liquidity is grabbed, what kind of price action do you see? Do you see, for example, my entry model for a reversal? Do you see like just turtle soups for continuation? Did the candle close above the level or not? Was it super bullish? Was volume dying as it was pushing? Like at that point in time, everything becomes a little bit subjective. Okay, it's really hard to give you like a rule that will apply everywhere because those are the things that become more abstract and don't really apply to every chart that exists. Okay, so next thing that I would do if I was to day trade this, to scalp it, uh, is first of all realize in what session I am in. For example, right now we are in the Asia session, so whatever happens, I know that we will probably not break a new high or a new low of the day because we generally don't break daily highs or lows during Asia. It depends a little bit on the asset because, for example, if you trade a forex pair that is, for example, based on the yen, the Japanese yen, obviously the Japanese yen is going to move more during the Japanese um, because it is a Japanese currency, it's gonna have more activity during the Asian session.
Japanese market open house.
Hello,
Also,
Milena. Um,
Thank you.
I'm recording this to YouTube, by the way. I'm not
Thank you,
live.
I'm recording this.
Yeah, I'm not live, but I'm recording.
Good.
Uh, because, by the way, context, because you weren't here, Alexa asked me what to do or how to do a completely new chart. Like if I don't absolutely have anything marked out, what to do and how to do it. So, continuing. If we are on the Asia session, for example, you can mark out the previous daily low and the previous daily high. Which, okay, I do. PD high and PD low. And you can expect price to not go much further away from these two levels. It can go, for sure, but it's just not as common, okay? Keep that in mind. It's just not as common, especially if these are New York lows. If they were created during the New York session, which they usually they are. For example, yes, this was at 1500, so it was like 2 hours before New York opens, and this was 4 hours after it opens. So these are New York highs and lows. So when this happens, most of the times we don't break them. Again, most of the times, okay? It can happen, obviously. But for example, immediate logic right now, we have a very big wick to fill. And we were talking just before starting the recording, we were talking about the idea of coming for 71 440 because we have stacked imbalances that we saw on EXO. 71 440. For example, that tells you that that stacked imbalance is above a high, is above a 30-minute high. which I don't have a template for, but let's put it there. So I already have two things to look out for just during this session. I know that there's a high chance that if we go above that high, we might get a reversal. And I also know, based on the 1 hour and 4 hour, that we have a big wick to fill, because wicks generally are filled. We have a big wick to fill, so any trade caught here could at least take us to that wick. Okay. Again, could. You never know for sure, but it's a possibility. Okay. So just as a little quick recap, because I'm going through things a little bit fast. Monthly, weekly, and daily levels first. Support and resistance zones, just to see if you are in a resistance or a support zone at the moment. Marking out the liquidity points, like what can potentially be a target. And in this case, we have these practically, stacked highs. Let's just say it's stacked highs. And we have these lows down there. In immediate section, like a very local section, all of these lows are actually kind of decent. The only thing that I would say, maybe it's these guys, which are equal lows. Not exactly equal lows, but very, very close together. So, for example, if you catch, for example, a New York short, getting down there is a possibility. Okay. Again, it kind of depends on which time frame you're on, right? For Asia, I wouldn't expect to go in there. It can happen, but it would be one of those situations that just don't happen every day. Okay. Generally, for Asia sessions, we stay inside the PD high and the PD low. Previous day high, previous day low. Okay. What does happen very frequently during Asia is that we take some liquidity somewhere and then move away from it. So if we take highs first, there's a high chance that we go down. If we take lows first, there's a high chance that we go up. In terms of marking out liquidity, my advice is to not do it lower than the 15-minute. Like minimum, do it at the 15-minute. If you want to catch trades that can actually give you a very decent reward. Okay. The reason why is because typically you're going to catch trades using the 5-minute, the 3-minute, and if you're crazy like me, the 1-minute. So, for example, if you try to catch a trade targeting a 15-minute liquidity using a 15-minute execution, your risk reward is probably only going to be like 3 to 4 hours, something like that, if it goes well. As a comparison, if you take a trade on the 1-minute targeting something on the 15, you potentially have 10 plus R. So obviously it's much more interesting to execute on a very low time frame with a tighter stop loss, but still a technical stop loss. And then having targets for the 15 time frame. This is especially powerful if we're talking about other sessions that are not Asia. Because, for example, typical behavior of the market is to, for example, London taking, for example, either the 50% or either the high or low of Asia and then moving against it, I mean in the opposite direction. And if London doesn't do that, New York will. It's just extremely common, happens practically every day. So keeping that in mind, it's also relevant for you to be aware of what is a New York high, what is a London high, what is a Asia high, because London highs and lows have a higher tendency to be held for at least the Asia session, whilst the Asia highs or lows do not. They don't have a tendency to be held for long, right? So after doing liquidity, only then do I need indicators. In this case, I get the points of control first, see if there's any naked ones, and I try to do this in a little bit higher time frame. For example, there is only one naked point of control down there, which is very funny enough practically on top of a daily level. So for example, even though there is liquidity here, depending on how we get to this level, there might be a possible reaction there for a scalp. And this is important to immediately create a group for that. And usually I call it volume and TPO levels. So we have that, and very locally we have yesterday's, because we're already on the 6th of June. Where's my line? Okay. Yesterday we got the point of control of yesterday, which is for now naked, right? Hasn't been touched yet. Nothing else. So, for example, keep in mind that there are not naked points of control to the upside. Okay, 0. There was one here, as you can see, this red line, and we reacted to it almost immediately. So this point of control might actually be an important point to what happens during Asia session. Where is it? Let's see. Okay, so for example, it's here. I'm just gonna put it like that, close to the candle. If I were a betting man, I wouldn't say that it's going to hold anything. Just because V-shaped recoveries like this don't usually hold price like that. But, you know, time will tell. We will see. The most interesting scenario for Asia on Bitcoin would be for us to come back down, take this guy, which is a 1 minute liquidity, so, you know, take it with a grain of salt. React to either this gap or somewhere close to it, and maybe do our reversal model. 1, 2, 3. Okay, this would be interesting because we could try to target that stacked imbalance over there, because again, stacked imbalances are generally a magnet for price. So this could be an interesting scenario. If this fails, then I don't think that these lows are gonna, that low, I don't think it's gonna hold. Okay, so after doing for example, just as a curiosity more, gaps and order blocks, I saved them in a group called S&D, so supply and demand. This, for example, is a liquidity, so I just mark it as liquidity. If I'm not mistaken, all of this is liquidity, right? Yeah. What's this trend line? Let's see. Okay, also liquidity. This is Oh, the stacked and balanced. Stacked and balances are a TPO level because it's red on the TPO chart, okay? This, for example, is the previous day high and low. I call them PD arrays, like the ICT guy used to call them. And what's that guy? Where is he? Hey, yo, where are you? Oh, it's liquidity too. It's down there. That is a price alert, but it's liquidity. Who are you? Okay, liquidity. This is a gap, supply and demand. And that is nothing. It was just to explain where the wick was. Oh, by the way, there's a ray missing. What's this ray? It's the point of control. So this ray, volume and TPO levels. Okay. So, all in all, just from this, we now have a possible plan. It would be interesting and smart to put an alert here and say 30 minutes liquidity taken when it goes off, if it goes off. We also have that point of control, so ND POC taken or touched, whatever. Okay, so now we have alerts for both the low and the high. Taking a trade right in the middle of our targets is fucking retarded, right? So this is the part where, you know, you can play League of Legends or whatever you want to do until an alert goes off. After doing this, only then is when I usually switch charts. Typically I go to EXO. Let me just change my workspace here. Loading.
Yeah.
While it is loading, do you want to ask something? Anything?
Um, mm, so those are the only levels on the higher time frame that you are interested in.
Yeah.
Like there is nothing else, nothing that I can't remember. That it's only monthly, weekly, daily, points of control, liquidity, like points of interest, liquidity,
Yeah,
supply demand zones. Those are like the beginning.
exactly.
After the beginning, after those levels, what do you do next?
What I'm doing right now. That's the plan based on what I'm saying.
Um,
For example, we were just talking about the idea of us coming for, it says here a PD POC. This is a previous day point of control. For example, if we come here and react to this stacked and balance with a bullish movement, this could be an entry to target those big stacks over there. At the same time,
Tricky one.
hello brother. At the same time, we have this stacked and balance over here. This can be seen as a possible trade, but it's a risky one. Why? Just because we are in the middle of targets. Okay? If you want to take the gamble, you can, but just be aware that you have to rationally, you are kind of obligated to yourself, to your account, to use a less position size because this is not the bottom or the top. This is the middle of the current price action. So if you take a trade from here, the responsible thing to do is to use a slightly less position size. Okay. And
What would you say with the stop loss? How far would you then put the stop loss in if you go?
Probably in this particular situation, I wouldn't just limit in on that. I would wait for price to do something.
Okay.
And so
Okay.
the stop loss would be dynamically decided based on what happens. If I was to use a limit, I would use it on the stacked imbalance, but not put the stop loss on that high, probably give it a little bit more room. Just in case it might just SFP the high and then continue.
Yep.
Again, that's the responsible thing to do because we have a target above.
Yeah.
So it's very simply just dangerous to take a trade here. Okay.
Yes.
Another thing that you can do is, but it's not really applicable to Asia. One thing that you can do is see where the VWAP is. Because if you are, for example, in London or New York, the VWAP has a lot more importance. During Asia, like the VWAP has just been created. So it's not as important. We do, however, for example, have a naked VWAP at 69,878. So I would also mark that. And you can check if you have more relevant ones. So we have one at 64193, 64193, and another one at 6858625. We don't really have more. Keep that in mind. That is why a short here has big potential. A short here has a lot of potential for a big trade. Because imagine just going from 71 to 64, right? That can be pretty big.
What does Frankenstein say?
Give
For
me
a
a
swing.
second, bro. You weren't here. Just context.
Oh, sorry.
You weren't here, but Alexa asked me, like if he were to start a completely new chart, what should he do, mark, etc., just to like do a clean analysis from scratch. So I'm explaining him like the steps to do that.
Perfect. Sorry for that.
No problem. So where was I? Do you remember?
You were at the naked points of controls of the VWAPs, and that the shorts are very, very inviting. And it's going to be a long short down from 72 to 54.
Can be. Like in terms of levels, naked points of control, VWAPs, everything. In terms of levels, I think this is it. The other things that you can do, basically, confluences to whatever you see. For example, one of the things that you can do is, if you know that you are in a range, analyze where in the range you are and where are the highest spikes in volume. For example, right now the most obvious one is the point of control, of course. You can, for example, mark them out with lines. Don't try to be too precise because we're looking at the daily, so you know, this is just zones. We have one there, one there. This is the point of control. Another one there. Another one over here. Another one. I'm not sure if I would put it here or here. Let's do it like this. And another one over here. And finally another one over here. As the last resort, I would also include this guy because it's below the lows. And to the upside, there's this guy which we already had a candle struggling against it. And to the upside of that, not much, right? There's also that one. Let's do that one because it might be where it's reacting to now, and that's it. Once again, save this, call it full range or just high volume nodes, for example, and include this inside. After this, everything is just confluence to decide a trade. You can, for example, try to understand how many movements there was. For example, we had one big push, and then one very impulsive push to a little bit consolidation and another one. In theory, we might start a new range here, which we kind of are, and the alternative to that is that, and this is by the way one of the things that I'm not sure about, is that maybe this is just one push and we are missing a third. This is completely possible. Timing doesn't really go with this theory because today is Wednesday. Unless tomorrow is the last push, typically we stop pushing for the rest of the week. We stop pushing on Thursdays. So it kind of depends what happens today, probably during the Asia session, because if we range, then maybe London can take the Asia low and push one last time and take out this high, whatever. We can do the typical TR pocket, which you already know about, which in this case the logic would be to mark it from the end of the move to its correction. And for example, that gives us 73,715 as a target, which would mean a possible SFP of the all-time high. You don't know, but it's another idea to consider. So all of the problem with all of these is that you're going to create several scenarios. It's kind of impossible then to decide on one single plan, because everything becomes a little bit subjective, and like everything is possible, everything this, everything that, you don't know what to follow, and you might get a little bit of a overwhelming feeling like there are too many options, I don't know what to choose, you know. And that is why generally, for example, I don't really like giving trade signals and stuff like that. I like to give points of interest so that people learn what to do and what to look for when we get to those points of interest. At the moment, our points of interest are the things that we marked out. Okay, our stacked and balance and our naked point of control, which by the way we're getting there kind of fast actually. Let me see what's happening on the 1 minute. Okay, we're getting to that naked point of control. Let's see what happens here. Okay, like I don't have, none of us has a crystal ball. We don't know for sure what's gonna happen. So what we can do is using strategies and entry methods that we know usually work. Try to see what happens when we get to those points of interest. And if we see one of those methods being a high probability trade, then we decide if we want to get into a trade or not. Okay. And I think that is it. So, questions?
Um, um,
Questions, comments, whatever.
so you don't find any levels on 1 minute or 3 minutes or 5 minutes?
I do that, but only when I'm looking for a trade. Like something on at least a 15-minute has happened. And when that something, which we don't really know what it is, when that something has happened, then I look into something under 1 minute. When something happens under 1 minute, most of the times what I do is look at exo and see, for example, if we are having stacked imbalances at where it's resisting. If, for example, we come here, does exo have a brush? I don't think so, right?
How do you implement your indicators? Because you have lots of indicators, and
My
how do you?
indicators? That's what you
Yeah.
asked?
Yeah.
You're talking about exo indicators or TradingView?
No, TradingView.
My main way of looking at them is what you already know. For example, again, if we come here and do 2 times a low, if it diverges in between them and then changes structure, that's one of the main tips to think about getting into a trade. But this is extremely subjective, and I'm saying it's extremely subjective because you can do that with an extremely simple RSI and just look at a simple RSI divergence. You can use the cipher B. You can use almost any kind of momentum oscillator. I don't know, there's hundreds of them. My indicators, for example, as you know, I'm always, from time to time, I'm looking into new things. What I have been using for a long time, as you know, is the RSI, comparing the highs and the lows. 2 RSIs basically, one for the highs, one for the lows, and if it's a bullish div, I look for, you already know this, I look for the blue line, and if it's the contrary, I look for the other one. So, and in this case, for example, what it's doing right now, this low stopped here, right? This slope stopped here, and I would, for it to be my real entry model, we'd created this low, we would have to take this low again. So we took liquidity, we took this low, and now it would be necessary for this low to be taken as well. And for example, if we do this, then I will look for a divergence between this and the next low.
Yeah.
Something like this. It has to
Off
be a
topic.
divergence then.
Off topic, but is this a turtle soup? There was a gap.
For it to be a turtle soup, there would have to be a gap, and there wasn't. The next candle closed it right away.
Wait. So sorry to diverge off, but it's still a good strategy. Turtle soup is one, for example, bearish candle, then 2 consecutive bullish, and the third will have to be again bearish.
You're mistaken it. Let me show you an example from gold, the one that I tried today. Which was
I'm following Bitcoin so we don't miss the trade.
Hey yo, where are you?
I saw it. Damn it. Yeah, exactly there, I think.
Don't think so. Or was it?
That
Wait,
was the block.
It was. Yeah. Okay. Understand this. Turtle soup is very highly dependent on the a continuation. It has to be in a trend.
Yeah.
So we are going up. Okay, this is the first logic. We are going up. We have
Yeah.
been going up. Okay. A turtle soup basically is you have certain lows and stuff. You have to take one of them, which we do here.
Yeah.
After this, you only think about possibly getting into a trade after we create a gap. So we only create a gap here. Doesn't really matter whatever happens here.
Oh.
Okay, because it doesn't happen because it doesn't have a gap. This price action doesn't have a gap. So you're only interested after this happens. Okay.
Mm.
So there is a liquidity grab, and then there's a push away from that liquidity grab. When there's a push away from that liquidity grab, you mark out the, so this would be your, the liquidity grab would be your protected low. This is your safest stop loss. Okay, because
Yeah.
it's the one that grabbed liquidity. And then you look for the things that are inside the zone of the fair value gap. So this is like the whole range. It's one of the possibilities. For example, you have this as an alpha block. It's another one of the possibilities. This is like your more general regular order block, okay? Like the inclusion of everything, of the whole range. And the turtle soup idea is that if you do a trade like this, you target 2 to 1.
Okay.
Okay. And for example, in this case, it used this. Okay, and then eventually went. But you have to already be in a trend. Only after you are in a trend, only then do you look at things like this. And you only look at them if you create a gap. Because if price action is choppy anyway, we don't even really think about it. Okay.
Mm-hmm. Okay.
And it's not because it's not going to work. It's just because the probability is lower. And that's it. No other reason, to be honest. Okay. So
Okay.
going back to Bitcoin, right now, for example, we haven't yet created another low. We haven't gone below this line.
Nope.
In terms of what I do, this is my reversal model. Okay. But again, that's in terms of what I do. It doesn't work every time. It's just a nice statistically. It's a statistically decent model for an entry, but that's it. There are 1,000 strategies different than this, and sometimes they work, sometimes they don't. It will always come down to what you're doing on in terms of risk management. But if you think about it, what we are doing here is basically using higher time frame things and then going into the 1 minute and doing the same things. If you notice, we're marking fair value gaps anyway. We're marking lows anyway. It's basically the same logic. Okay, it's just like price is fractal, right? So it's just about going into a deeper time frame. Jesus, that was fucking loud. Okay. So for example, we are in that situation. Now we would check for a div. And for example, just as long as the RSI does not break this low, this is a valid divergence. Depends on what price does from here.
If it does not plummet from here.
Yeah, if it's just plummets, then it's not a trade. Period. End of story. You know?
Yeah.
It just barely touched the fair value gap over there.
Yeah.
So
Perfect.
at least until now, it's looking good for an entry. We don't really have anything special on EXO yet. Keep in mind that price can still come for the stacked and balanced. There's a high chance. So yeah, it really depends on what it does. And this is one way to try and have a higher win rate, which is don't just limit in on trades based on what you think might happen. Set your alerts, but only react if you see a reaction that is typically what happens when price gives you a potentially good trade. Okay.
Mm-hmm.
What else? Anything more that you want to know or thinking about?
Is that all? Like everything you do
Yeah, pretty much.
day-to-day basis on the charts.
Pretty much, yeah.
Wow, I thought it would be much more.
It looks like more because when you look at my chart, everything is already done. You
Yeah.
don't see me doing from the start, right? And because
Yeah.
everything is already done, you think like, holy shit, there's so much info on the chart, like it's impossible for me to even understand it, right?
Yeah.
If you do it yourself, and that is also one of the reasons why I keep telling you, like, you have to do it yourself. You have to, don't copy anyone, just do it yourself and organize the chart and everything. You'll understand, like, it's kind of like creating a project. For example, if you create a project, if the project is yours, only yours, and if you spent like, I don't know, 2 months, 3 months working on the project, whenever you look at the project, doesn't really matter what day of the week it is, whenever you look at a project, you'll remember everything because you did it. It's your creation, right?
Yeah.
But for example, if you show me the project and I'm looking at it for the first time, I'm gonna be completely lost. I'm gonna feel completely lost because I didn't do anything of that. I didn't have your initial thoughts, or I didn't have anything that went through your brain when you were doing it. So I will feel completely lost. And if I show you a chart completely full of everything that I ever marked, even the things that are not relevant for the current time frame, of course it's gonna look confusing. That's why, for example, when I share my analysis, I usually share 3, 4, or more images so that I can show you guys kind of like step by step what I saw. Because everything is going to be like almost like a foundational block. So something that we go from here, and from here we have that, and from that we have this, and so on and so forth. If I just show you all like um, in one go, it's just too much to take in. It's kind of impossible to understand it. But
Okay.
yes,
Okay.
basically that's it. There are 1,000 other things that you can keep adding. Fibonacci, TR pockets, what reaction happened where. Like, there are 1,000 different things that you can look at. It's not going to be like it's not going to be universal. You know what I mean? Like, the things that I like to watch probably are not the things that you are going to be enjoying to watch, because I just might have a different strategy than yours. And you might not, um, you know, you might not just like it. It can just be a matter of taste. You might like using vectors more. For example, Javi likes to use vectors a lot, and especially in gold. For example, I'm starting to not care too much about vectors, because well, the more you trade gold, the more you understand that vectors do have some importance, but not as much as Bitcoin, for example. So every asset will work differently as well. So you should also treat every every asset in a different way as well. Don't think that every strategy that you do on Bitcoin, for example, will work on, I don't know, the S&P 500, for example.
Mhm.
But there are some universal things like the liquidity grabs, the reaction of each session, for example, the intra-session behaviors that I posted about on the premium channels, some entry models, the importance of kill zones. For example, kill zones are going to be more commonly a liquidity grab moment. After the kill zones, you might start a trend, but usually you don't start a trend in a kill zone. Well, you can start a trend on a kill zone, but generally it's only after it takes liquidity. That's what I mean. Like liquidity first and then maybe a trend. So there's a thousand different things, especially if you go on Twitter, then oh my God, you're gonna find all types of strategies and everything that can create all kinds of biases on you, and have different plans. Just comes down to what's your personal preference and what are the things that like the more you trade, the more you're gonna start feeling like, yeah, okay, I like using this, I feel more comfortable using this and that.
Yeah.
But that really only comes with practice, man. If you don't practice, like you can study any YouTuber or any book, any strategy, you can study anything that you want. If you don't practice it, or at the very least backtest it, you're gonna be always like jumping from strategy to strategy and stuff. And try to remember that a strategy doesn't work all the times. Every strategy will give you losses. If you, for example, if you start doing a backtest on a strategy and you have like 4 losses in a row, don't change strategies right away. First, analyze if you're actually doing the strategy right. If you
Yeah.
are, like, just do a bunch more trades, because what it matters is in the long term, how well does it perform.
Yeah.
And also try to not fall into the trap of finding the holy grail, the perfect strategy, because first of
There
all,
is.
I highly doubt that there's something that works every time. That's kind of like searching for perfection. And much like in life, if you keep searching for perfection, you're gonna be a very miserable human being, a very unhappy human being. Because what's nice about chasing perfection is the actual journey, not reaching perfection itself.
Yeah.
And if you just focus on trading well, sometimes you're going to find yourself not even using a strategy and still winning, just because of you have so much screen time looking at that chart, and sometimes you just know that it's highly probable that something is going to happen, and so you take a trade in that direction because you've seen it a bunch of times and you know that it's likely to happen, even if sometimes you get it wrong. Um, you just kind of know. It's not like a written rule or something, you just kind of know.
Yeah.
So yeah, I guess that's it, man.
Thanks, man.
We
Thanks
did
very much.
we did our little model here. It's barely creating a div. At
Um,
this point in time, based on what we see on EXO, we might come for this stacked imbalance. It's
Look
at
at the gold.
79.35. Gold is just ranging right now, right? Yeah, it's just ranging for a little while.
It took the high.
Yeah, I saw it.
high.
Yeah, I know.
Maybe it's time to long.
Because it took the high?
And it's it's pumping again. I thought on maybe on retracement. And there were this.
Because it took the high, it would have been nice to short when it took the high, not right now, right?
Yeah.
Now you were saying it's time to long. Why?
No, I thought before this pump, I think I saw the divs. Like it was divvying, for me at least, across the board.
Try to not take trades every time you see divs, man, because you're gonna get fucked sideways every time.
Yeah.
You have to have a bigger context than that, not just like, oh, there's a div, I'm gonna take it.
No, I thought there was a div, and we closed above those highs, and we have some protected lows down there.
Yeah.
But now I see the difference. Like it would be a big stop loss.
Yes, it would be a big stop loss. It
And
had
you
already retraced anyway, so
yeah.
your entry is gone now technically.
Yeah.
To be fair, we didn't really take liquidity to the downside unless we just include. Give me a second. Oh, this is not my.
Yeah, go back.
Let me change. Come on. For example, just as a comparison, this is a subjective turtle soup in the sense that yes, we are going higher, but right now we are in a kill zone.
Oh, still?
And yeah.
Oh, is that kill zone? That red?
Yeah, it should be
Done.
The Asian kill zone is typically 2 hours, maybe 3. And we just grabbed the low, but it wasn't. It was the internal low. We're not exactly going for other liquidity grabs. I would wait right now. Too many vectors and everything. I would wait a little bit.
So you think in next 5 minutes there is no trade?
No, I'm just saying
what
that. Yeah, I'm just saying that 1, this is a kill zone. 2, if this was a good trade, which might be, I wasn't even looking at it. We were talking about Bitcoin, so
yeah,
good entry was there, right? Not.
Yeah, I wanted there, but holy smokes, look at that.
Yeah, kind of a typical kill zone movement, just going for something.
And I will TP right now.
I did.
Hold it.
Hold it. During New York, I did talk about this. I don't know to who. About us taking down 2, 3, 5, 9.
Go down and close pitch. Oh, it's not closing. Now it's gonna pump to previous.
Because it's a vector. It's liquidity. So again, it's the same logic, going from liquidity to liquidity.
Oh, what is that single print? Oh, is that on the chart on the EXO? So you mimicked back?
Yeah, I copied them. But no, this is not on EXO because we don't have gold for EXO. You can, I mean, you can't because you're on a free plan. But
yeah, can't see
whoever has premium can activate TPO here, and it will create these very thin lines. I don't know if you can see them.
Yeah.
These purple lines, those are single prints. So this one ends here, and it ends here and starts here. So the single print is this whole area from here to there. And yes, basically I just open up the TPO tool and see where they exist. So, for example, right now I'm interested in seeing what happens here. We're super close to it.
Hey, these moves, man. These moves.
Actually, let me remove that, because it's gonna be super loud again when I'm seeing it. Okay, so
Oh.
logic is we take in liquidity, kill zone is maybe over. From here on out, we might have a short.
Short on that line. Limit short.
So,
What?
so now we
It's
would
called?
be looking at targets. And we have, okay, I can delete this as well. This was also taken.
Bro, first that HVN, that high value note would pass you the challenge, man. My challenge.
That was a crazy little tap over there.
Yeah. Well, what now?
Now we wait.
Now we wait to take the high again and form the div and then short it? Or...
I'm going to say maybe, because this reaction is super intensive.
Yeah.
Speaking of which, I haven't opened up Trade Locker today. Okay, so I'm gonna shut down the recording then.
Yeah.
Oh my god, like and subscribe and share and stuff. Bye bye. Okay. YouTube, see you soon.